So in this video, I'm going to be making a short clip on how to pick your point of interest correctly. So the first thing you need to understand is you need to understand what side of the market are we on. Are we on the bearish side of price action, or are we on the bullish side of what? Price action. And then before you anticipate a flip in the market structure, price must at least hit a key level on the higher time frame. It can either be an order block, a breaker block, a rejection block, a fair value gap, or any point of interest you have. Then the next thing you want to see a shift in market structure above the previous high. And before price will shift that market structure, price must take out what? Sell side liquidity and then break structure in the opposite direction. So what if you miss your initial entry, either at the order block or the breaker block? What is the next thing you do? The next thing you need to do at that point in time is you need to wait for what? For price to break structure again in that direction. Okay, agreed, you've seen a break of structure, but how do you know that break of structure is valid? There must be a sweep of liquidity before that break of structure occurs. That increases the chances of that point of interest holding. So the last extreme zone that swept liquidity is your key level in which you want to buy your setup from. But for every trade, for every buy order, there must be an equivalent sell order for a trade to actually take place. What does that mean in essence is if you found a point of interest in which you want to take your buy trade or your sell trade from, there must be a sell stop in a buy order. There must be a sell stop resting above your point of interest as a form of inducement. Now you can see that we have two valid zones. We have valid zone 1 and we have valid zone 2. The question is, where do you expect price to actually react from? The best way to go about it is what? Measuring out your premium and discount array in that particular area. Mark out your kilo, all right? Sorry, you mark out your kilo, then expand it to the expansion, to the expansion high, all right? And look for price to come into discount. And if you notice, price what is in discount on both PDRAs, which make them what? Very much valid. Point of interest 1 and point of interest 2. Now, having that in place, you need to understand that now that you have two valid interests, that is when you can now take what? The both setup, meaning you can decide to place your first limit order at this order block, at this extreme zone. But one thing you need to put in place is there must be an order protecting that your point of interest. Now, that is what will make your trade what? High probability. Having what? A sell stop what above your buy order is what will make your trade high probability. Now, the best way to actually go about it is what? To avoid setups in which what the point of interest are in premium of your expansion, because as a trader you're trying to buy at what? At a discounted price and sell at a what? At a premium level. So one of the key things you need to put in play in understanding your strategy is you need to understand that to pick your point of interest correctly, regardless of how you trade, you need to understand that there must be a grab of liquidity before your structure will break in the opposite direction. If you find scenarios whereby price action, all right, in which you just found raw break of structures, there was no sweep of liquidity before that break of structure, that break of structure will most likely fail and acts as trap for what? For retail traders, and then price will go up into the level in which liquidity was taken. All right, now I'm going to be putting on some little examples that I've gone through in the past, and I'm going to be showing you how to actually implement them correctly. So this is example 1 of how I actually took a trade on this particular pair. So the first thing I need to understand was I found what? A break of structure in the bullish trend, indicating there was a continuation of a trend. Now, right before that break of structures, what did I observe? They were what? Grab of liquidity. Liquidity was being taken at the sell side. All right, liquidity was constantly being taken, and there were rejection of what? Of old lows. Now, price rejected old lows, and then price broke above what? Old highs. Now, where is my dealing range high and where is my dealing range low? The last break of structure, the high that caused the break of structure, and the lowest point of the break of structure is your daily range. Anything outside that zone is none of your concern. What are you trying to do? You're trying to look for an area, all right, in this daily range high to daily range low for a high probability setup to actually take a very good trade. So what do? The second thing you need to do is you need to measure out your daily range low to your daily range high. All right, so now why are you trying to do that again? What is the next thing you're trying to look for? You're trying to look for price to drive into discount for you to buy price at a cheaper level. So what do? You can go down to the lower time frame to look for key levels in which you anticipate price to react from. All right, you need to look for areas you need to anticipate price to reverse from. So from this little depiction over here, this area is a valid order block. This little zone over here. Now, why is it a valid order block? There is a grab of liquidity, like I went over earlier. There's a high, there's a low, there is a raid of a low, then there's a break of structure in the opposite direction, making this area a valid level to buy price from. All right, now we'll go down to the 15 minutes time frame to look for more structures to actually take this high probability setup. Over here, we can now trim down our entry to this area. Then our stop loss come right below this. All right, then, like I also said earlier, for a buy setup to be valid, you need to find sell setup that price will most likely take out for the setup to be valid. Now we have resting liquidity above our point of interest in discounts. Everything is being paired up together, and then we're targeting what? Buy side liquidity. So your first trade can come from this area in price. Your entry at this level, your stop loss below that area, then you're targeting external range liquidity. So this is staggering 1 to 5 risks to reward. But what our advice is to keep your stop loss below the 4-hour low to be on the safer side of price action, or in case you have a fixed risk to reward. Now what do? You wait for price to do what he has to do. Wait for price to reach in for your point of interest, and your trade is being triggered in. So like I said earlier, in case at any point you miss out your initial move, this is an expansion to the upside, what do you do next? What do you do next? You look forward, lower time frame structure that you can buy your setup from. So this is the 15 minutes time frame. The next time frame I want to step up into will be what? Will be the 5 minutes time frame. So over here on the 5 minutes time frame, I need a valid zone that, of course, price has taken out the low. All right, so make it a valid area to take a buy setup from. So price took out this low over here, this opposing candles low. That makes it what? A valid zone for me to be able to take my buy trade from. So I mark out the high to the low of the zone that price took out the liquidity. Then I draw that out, and that will be what? My valid zone to buy from. And like I said earlier, we need a sell stop to be taken out for our point of interest to be valid. Now we need an inducement that at least covers at least 50% of our dealing range. All right, we need to see at least price pull up at least 50% of the daily range before we can see our point of interest getting triggered. Mind you already have a running trade from the low, but just in case you miss out on the initial move, this is another setup you can take from the east area. Then your stop come below this area. But since the inducement has not been formed, you keep watching price until price actually creates that particular inducement. So moving on. So price has created a very decent level of inducement because price have moved at least 50% of the daily range at this point. Price have moved at least 50% of the daily range. Once the price wants to reach up into our key level we have price resting or liquid the point of interest resting that wants to take a very valid set up. So we wait until price take out this buy side liquidity. Our setup remains valid for a very good trade opportunity. So our point of interest already got triggered at this point, and we can see an immediate reaction from our point of interest.